Every major economic collapse I have ever studied has one thing in common. The people who built generational wealth during it did not react to the crash after it was already on the screen. They prepared for it before the crowd knew what it was looking at. That is the first thing I want you to understand. For decades, ordinary investors have been told a story that sounds responsible, and for many of them, it is responsible enough. Crashes are unpredictable. Diversification is your shield. Stay invested. Do not try to time the market. Do not overthink it. Let time do the work. For a very large group of people, that advice is not crazy. It is serviceable. It can get them through life with fewer self-inflicted wounds than they would otherwise create. But that is not the playbook sophisticated money runs when the cycle starts turning. The very wealthy do not wait for the newspaper headline telling them the crash has arrived. They begin moving 18 months before it becomes obvious. Sometimes 24. They do not do that because they have a crystal ball. They do it because the same stresses appear again and again in different costumes. Credit stretches too far. Liquidity gets too easy. Valuations separate from reality. Leverage becomes respectable. Then the system begins whispering before it screams. That is when the prepared money starts shifting. I have watched that behavior long enough to know there's a pattern to it. The pattern is not philosophical. It is practical. It is not built on television language. It is built on the question every serious allocator asks when a cycle is getting dangerous. What do I want to be holding when everyone else is forced to sell? That is the whole game. Crashes do not just destroy wealth. They transfer it. They transfer it from the impatient to the patient, from the leveraged to the liquid, from the people who were conditioned to believe every asset should always be working, to the people who understand that one of the most important assets in any serious portfolio is optionality. That is why I want to walk you through 5 categories of assets that appear with astonishing consistency before major economic breaks. Some of them are available to almost anyone. Some of them require scale, access, or structure. But the principle under all 5 is the same. Rich people do not prepare for a crash by guessing the headline. They prepare for it by holding the things that become more powerful when other people lose room to think. The first one sounds so boring that most people dismiss it immediately. That is one of the reasons it works. Before the dot-com collapse, before the financial crisis, before the pandemic shock, one of the most reliable behaviors among sophisticated capital was the buildup of short-duration government paper treasury bills. Cash equivalents are so dull that ordinary investors look at it and think nothing important could possibly be happening there. That is because most people misunderstand cash. They think cash is the thing that costs them return while somebody else is getting rich. The wealthy think about it differently. They think about cash and treasury bills as the one asset class that does not need anyone. Cooperation to turn into anything else at the exact moment. Everything else is under duress. That distinction matters more than almost anything else in a crash. I have always respected that distinction. People spent years mocking large cash balances as dead money. They said it was lazy. They said it meant the person holding it had lost conviction. They said the market would leave that person behind. What they never seemed to understand was that cash is not a bet against opportunity. Cash is stored purchasing power waiting for prices to become irrational. If you are sitting on $10 million of short-term government paper yielding a modest return while the market is rising, you can look foolish to people who only judge intelligence by what worked yesterday. Then the crash comes. Extraordinary businesses fall 40%, 50%, 60%. Real estate freezes, credit seizes, equity owners panic. The person who held liquid government paper is suddenly the only adult in the room. He is not trying to survive. He is shopping. That is the function. It is not exciting. It is lethal. Crashes require sellers. Sellers require buyers. Buyers require cash. Most people arrive at the crash with opinions. The wealthy prefer to arrive with ammunition. That is what treasury bills really are in a late cycle environment. Ammunition. The second asset is one that ordinary people rarely understand until after the money has already been made, because the mechanism is hidden inside legal structures. They do not spend time studying. That asset is distressed debt when a company approaches bankruptcy. The public usually sees only the equity chart collapsing toward zero. They assume the business is dying and the story is over. The sophisticated money looks at the bond stack instead. This is one of the great dividing lines between amateur finance and serious finance. The amateur sees the stock, the professional studies the capital structure. When a company's bonds fall from par to 20 cents or 15 cents on the dollar, that does not always mean they are worthless. Often it means the market has stopped pricing them like debt and started pricing them like a claim on future ownership that nobody has the patience or the legal imagination to analyze. That is where the opportunity begins. The reason is simple, and it is worth understanding at a very mechanical level. In bankruptcy, the holders of common stock are almost always at the bottom of the waterfall. They do not get rescued by optimism. They do not get rewarded because they believed in the story. If there is not enough value left, they are simply wiped out. The debt holders sit above them, the senior creditors sit above the junior ones, and when the company is reorganized, those distressed bonds can convert directly or indirectly into ownership of the reorganized business. The investor did not buy stock. He bought debt when everyone else thought the story was over. Then the legal process hands him the equity when the dust settles. That is why distressed debt is not merely a trade on survival. It is often a stealth mechanism for taking control of assets at a fraction of their replacement value. That is a very different thing from buying a weak stock because it looks cheap. When General Growth Properties went through bankruptcy after the financial crisis, the casual observer saw another casualty. Sophisticated capital saw a vast collection of hard assets, contracts, and locations being repriced by panic. The people who bought the debt at distressed levels were not making a sentimental bet. They were using the bankruptcy code as an ownership transfer machine. This is uncomfortable to say out loud, but it is true. Every major downturn produces a wave of broken balance sheets. Those broken balance sheets become raw material for investors who understand law, priority, and patience better than the people who owned the equity on the way down. That is not a conspiracy. That is the structure. And once you see the structure, you realize that every recession is not just a period of pain. It is also a period of redistribution. Productive assets move from dispersed, optimistic hands to concentrated, liquid hands through mechanisms most of the public never bothers to study. The third asset is older than bonds, older than equities, older than central banking, and in many ways more primitive and more enduring than all of them. Productive farmland long before Wall Street existed, land that produced food, was wealth. Not symbolic wealth, not theoretical wealth, real wealth. Wealth you could eat from, trade from, finance against, and endure from. Modern investors sometimes forget that because they live so deep inside a financialized world. They think the most important assets are the ones with the fastest moving tickers. History is less sentimental. History remembers what people still need when the paper system is under stress. They need calories. That is why productive agricultural land behaves so differently from so many fashionable assets during crises. It is anchored to necessity. It is not merely dirt. It is productive capacity tied to human biological demand. That floor is very hard to replicate. Good farmland does not depend on a central bank to remain necessary. It does not depend on consumers feeling confident enough to buy the next software subscription. It does not depend on venture capital continuing to flow. It does not depend on rates being pinned near zero. People keep eating when markets fall, and when the currency is being diluted, the land does not vanish. If anything, land that produces something the world must keep buying often becomes more precious, not less. That is why rich people keep coming back to it. Not because it is romantic, because it is anciently rational. Over long stretches, prime farmland has compounded quietly, while large swaths of the financial world chased what looked more sophisticated. During periods when commercial real estate was collapsing, farmland often held up. During inflationary moments, it behaved more like a real claim than a paper promise. When Bill Gates accumulated a huge amount of American farmland, people tried to turn it into a personality story. I am not interested in his personality. I am interested in the logic. The logic is straightforward. if you can own a scarce, productive, hard asset tied to permanent demand. You own something with a kind of gravity paper assets cannot imitate. There is another subtle point here that matters. Not all farmland is equal. Land producing crops with export demand and global pricing power is different from land only serving a weak domestic market. The best version of this asset is a productive claim tied not merely to dirt, but to sustained external demand. That matters enormously in any environment where the local currency or local economy is the very thing under pressure. The fourth asset is one I speak about with more caution, because personally I prefer productive businesses to cultural objects. But I would be dishonest if I told you sophisticated capital ignores this space before crises. It does not. That space is blue. Chip fine art, not the decorative stuff people buy because it matches a wall. I am talking about major works, major names, works with deep provenance, institutional legitimacy, and finite supply in the most literal sense because the artist is dead and not making more. This is where many people shut off their minds because they think art belongs in magazines, not in capital allocation, but the ultra. Wealthy do not think about it that way. They understand something basic. In a world where central banks can create money, deficits can explode, and paper claims can be issued endlessly, anything with permanently fixed supply and globally recognized value becomes structurally more interesting. That is the first reason serious money enters that space. The second is that high-end art often moves through private channels, not just public auctions, which means large buyers and sellers can transact in ways that are far less visible than what the average investor is accustomed to seeing. During periods leading into dislocations, private treaty activity has often risen sharply. That is not because collectors all suddenly became more passionate about beauty at the same time. It is because capital was quietly rotating into something scarce, portable, and not tightly correlated to the conventional financial system. Now let me be clear. I am not telling ordinary people to rush out and start buying paintings they cannot evaluate. That would be foolish. What I am telling you is that the behavior is instructive. Rich people use asset classes the broader public thinks of as eccentric, because those asset classes sometimes serve a very practical role. They preserve purchasing power in an opaque, finite, globally legible way, and in a crash, opacity and scarcity can be very useful friends. The fifth asset is the one that matters most, because the first four are mostly about protection, preservation, and positioning. The fifth is not primarily defensive. It is offensive. It is the mechanism through which entirely new fortunes are built when the economy breaks. That asset is essential: service monopoly businesses. If you want to understand how wealth gets transferred in recessions, study this carefully. The businesses I am talking about are not glamorous. That is why the public ignores them in good times. Waste hauling, self-storage, funeral services, pest control, water infrastructure, medical waste disposal, utility, like local service businesses with recurring demand, limited competition, and customer behavior that does not meaningfully change because GDP had a bad quarter. These are not dinner party businesses. That is exactly why they work. When the economy is booming, they are too boring for most people to care about. Nobody assigns them a fantasy multiple. Nobody starts a cult around them. Nobody convinces himself that buying them is participating in the future. Then the downturn comes, and suddenly their boring qualities become lethal advantages. People still make trash in recessions. They still need storage when they downsize. They still die. They still get infestations. Hospitals still produce regulated waste. Water still has to move. The revenue line on these businesses does not care much about your mood, your politics, or your market cycle that matters. But there is another layer that matters even more. During downturns, the large, well-capitalized owners of these businesses get to buy weaker operators at liquidation prices. The smaller competitor who financed his expansion with leverage now cannot refinance. His trucks, routes, contracts, equipment, and customer lists become available at prices that have almost nothing to do with their long-term cash generating value. The buyer with liquidity and discipline consolidates the market while everybody else is trying to survive the storm. That is how real fortunes get built, not by buying the thing everybody wants in good times, by buying the thing nobody celebrated in good times, and that becomes even cheaper in bad times, even though its cash flow never really broke. Wayne Huizenga understood that better than most people ever will. He did not build waste management by chasing glamour. He built it by consolidating a dull business that nobody romanticized, especially when the economy was under pressure. He understood that boring, recurring, essential cash flow is exactly what becomes more valuable when the environment gets hostile. This is one of the great secrets hiding in plain sight. The public thinks the money is in what is exciting. Sophisticated capital often knows the real money is in what is indispensable. That is why I say crashes transfer wealth. Because what really happens in a downturn is not just a fall in stock prices. What really happens is that fragile ownership structures get wiped out and durable ownership structures expand. The overleveraged owner becomes a forced seller. The liquid owner becomes the acquirer. The person who thought markets were about endless upside stories becomes a bag holder. The person who understood that cash and boring cash flow are weapons becomes richer. That is the transfer. Now, I want to tell you what I think matters most in all of this, because it is bigger than the 5 assets. Every major crash in modern history has not been a random meteor strike. It has been a cyclical redistribution event. Wealth moves from people who had no structure into people who had one, from people who relied on the system staying easy into people who prepared for the system getting hard, from people who believed diversification alone was a sufficient philosophy into people who understood that certain assets become disproportionately powerful. When the cycle turns, the middle class is usually taught how to behave after a crash. The wealthy prepare how to behave before one. That is the difference. They are not necessarily smarter in the abstract. They simply ask different questions. They do not ask, what should I do once the market is down 35%? And every talking head is shouting. They ask, what should I already be holding 18 months before the market gets there? That is a much better question. And if you answer it correctly, the crash stops being only something that happens to you. It becomes a period you are structurally positioned for. Let me make this practical. You may never buy distressed debt directly. You may never own hundreds of acres of productive farmland. You may never participate in private treaty art deals. You may never acquire a regional waste management operator during a recession. That is fine. The point is not that you must mimic every vehicle. The point is that you should understand the principles. Cash is not laziness. It is optionality. Boring essential businesses are not inferior. They are often superior when the cycle turns ugly. Hard productive assets tied to enduring demand matter more than financial culture. Admits the legal structure of claims matters more than the public equity market teaches you. And the best buyers in a crash are always the people who prepared before they needed courage. That last line is the one I want to leave you with. Most people think courage is what matters in a crash. It does matter, but courage alone is too late. The courage to buy in a panic is useless if you arrive at the panic fully invested, over-leveraged, overconfident, and illiquid. Preparation creates useful courage. That is what the wealthy actually understand. They do not just brace for impact. They decide in advance where they want to be standing when the pricing breaks. They do not wait until the shopping event begins to wonder where the shopping list is. They already wrote it. That is why every downturn feels to the public like chaos and to the prepared like inventory. And that is the uncomfortable truth hiding under all 5 of these assets. The financial system does not merely reward intelligence. It rewards structure. It rewards patience. It rewards the person who can remain solvent and calm long enough to buy from somebody who can no longer afford either. So here is the question I want you to sit with. If the next crash is already casting its shadow into the present, into the cash piles, the quiet acquisitions, the short duration positioning, the appetite for productive land, the consolidation of essential service businesses, the build-out of legal claims on future ownership, where do you want to be standing when it arrives? Do you want to be the person reacting to the crash or the person who prepared for it? Because every major cycle eventually forces you to reveal which one you really are.